Good day, this is Cameron Trade from Holo Trading and Projects. Holo Trading Academy is a division of Holo Trading and Projects. Today we are about to explain a common phenomenon that appears within the markets where we have a schematic, or in other words, a setup, right? Usually this setup entails that there is a lot of manipulation happening within the markets where you have to be very specific in your entry and where you want to enter the market. So basically, the market was in a downtrend, pushing down. Then we had a change of character. We broke a previous structure, right? And we enticed people in taking a buy, right? We enticed people in taking a buy. And what does that mean actually? It means that there were buyers within this area. There were buyers within this area who saw a possible head and shoulder pattern, right? And in this case, the market, it created an area within the market that is like a pool of liquidity. It's a pool of liquidity. So within our curriculum, we call it a sell side liquidity. It's an area where there's stop losses, sell side liquidity. It's an area in the market where there's stop losses of early buyers or particular buyers who entered the market, and they have stop losses around somewhere in this area, right? Assuming we're going long, taking a buy, right? We know that within this area, right, there are stop losses and we want to take out a previous high, right? Because there's an engineering of liquidity, which is like relatively equal highs. So what happens most of the time is that the market tends to seek to buy at a lower price. We are going to add in a bit of a Fibonacci zone. Why? Because it shows us discount and premium levels. The light shaded area is premium price point. The dark shaded area is discounted price zones. We know that price is so engineered that it will buy lower and it will sell higher, right? So when we're a buyer, it's much more better for us to buy at lower prices than to buy at an equilibrium or premium prices. So this entails that when we seek to buy, we'd like to buy at a fairly lower price after we've taken out some liquidity zones. And aiming at the same exact target, but this time we have a much greater risk to reward. We have a 1 to 8. Here we had a 1 to 2, and we had a pip value of 141, and this side we had a pip value of 213. So it's much more better for you to start to look for buys at a lower price point than at the medium price point. Now let's go to the chart and try to spot this phenomenon, right? Let's spot this phenomenon. Well, this is not a clear picture perfect setup, which is the market is not entirely picture perfect, right? So what do we have? We have sell stops that were taken, right? We had a break of structure and change of character, right? Now let's look. We pushed up, came down to the previous bullish order block, right? Why didn't we actually take this area into consideration as a buy area? Why didn't we look for buys in this area? Because it's a bullish order block as well. Same as what we described up top. It's just that the schematic is not the same. we need to look at where is price. Are we going to look to buy in the middle, like here? Look how horribly it failed. Are we looking to buy this 2-3 hours, or we willing to take it to the low side and buy at the discounted price zone, a deep discount? Mind you, this is our bullish order block, and here also was a bullish order block, but I'm looking at the 50% fib zone, right? Would we want it to be a buyer here? At this zone, or a buyer at this level? So you see, this area gave us a 42 pip range, and this one gave us a 65 pip range. Which one is better? Which one is better? This one was a 1 to 4. This one was a 1 to 3. I believe this one was much better. And let's just, take everything a bit back. Take everything a bit back. Sometimes it's better to have a proper confirmation, like in terms of the market actually on this side, right, where price was actually engineering it to show us that is looking to move to the upside, right, which is another break of structure. Let me just add this here and delete this section. So in this case, we had a confirmation of a break of structure, and we had a reversal, right? Mind you, this area here within the market, let me look for ellipse. This area here within the market is not per se a reversal, but more of a correction. It's more of a correction, and it's closing in the voids that were made within the zone, right? Price tapped into the zone, pushed up, came again, another scaling in opportunity, right? Wanting to take out the high, right? Price pushed, push. Look what it did. Gave us an opportunity to enter. Again, scaling in. But this time, the scaling was not actually a correct idea. So let me just look to my left what caused the sell, which is this area over here. Alright, let's just say the price actually moved that other side. Mind you, that was like a beautiful 1 to 9.6 risk to reward, risking only 7.9 pips to make 76 pips, almost 1:10. right? Now let's have a clear look. Okay, let me just delete this, right? What do we clearly see sometime now? We can see that there was engineered liquidity. Engineered liquidity. Price, when it pushed up, came again, but it left a huge orders, stop loss orders of sell stop guys that have sell stops and people that have buy pending orders, buy limits, right? Right. Price came, tapped into the buy limits, were in profits, the stop losses were taken out. Right? Let's see now here. Right? As you can clearly see, above were orders, liquidity zones, right? Above here, also money. Price eventually took that out. So let's just try to go back to that nice example that we had up top. Even though we didn't have the perfect one, but we have something similar, right? In this form. Where we have a break of structure, engineered liquidity is better for us to look for buys where below the areas. It's better for us to look to buy below the areas, right? Then price pushed, right? We had a sell side liquidity, price pushed, confirming that we have changed character from the downtrend, right? Retest to an area to push, came again, same area, pushed at a push, engineered liquidity. Engineered liquidity, price sold to do what? To tap into the real buys, the strong buys. You know, this was a much more refined, low resistant entry. Let's just see what stop loss. If we were to take it here, we would have it at 15 pip stop loss. Still very beautiful, very low risk, very low risk. So that was that schematic, guys. That was that schematic. Let's look for a model where it's selling, right? So a model where it's selling is actually the same as the buy, but it looks a bit different, right? Where we have price pushing up, price going down, price taking out this liquidity to the upside, right? Then price breaking structure. And when it broke structure like that, it started to engineer liquidity. Engineer liquidity. Then tap into probably a fair value gap or an order block. To do what? To sell. Right? So what did we have? First, taking out some buy side liquidity, buy stops ran, right? Then we have a change of character, change of character. We have engineered liquidity to the upside. We also have liquidity on the downside, right? So somewhere here, either a fair value gap or we have an order block, right? Mind you, this is a liquidity zone. This was a high previously. Let's look to our left. Okay, let's use this specific high, right? Let's just use this one for argument's sake, for basis sake. We're using that high as our previous high, and this one just because it's closer. Buy stops ran, buy stops ran, right? So what do we have? We have clearly a big break of structure. But before the big break of structure, we have a bit of engineering where structure is changed, right? Price goes back to a notable order block, creates an order block as well on the side, right? Engineering liquidity, relatively equal highs, relatively equal lows, engineering of liquidity, right? Just have a break of structure. So tell me, why don't we have a big sell order on this area? Of course, the price pushed to the downside. But why didn't it go to seek out to take out these lows initially, right? Because price needed to go back because there was a liquidity zone on this part, the relatively equal highs, and also on our left we had a liquidity void, which is an imbalance. A liquidity void. So it's much better for us, being sellers within the market, to be very patient and wait for price to sell at a very premium price point, right? So let's just pull up our Fibonacci from high to low. We don't want to sell at the midpoint. We want to sell at the deep discount, this deep premium, I meant to say, excuse me, at a deep premium, right? So that was the catalyst of how we actually saw that one. So that was our schematic, actually. That was our schematic, our setup, the basis of how we actually look for trades within the market using the tools that we've learned thus far. I hope this has been very insightful and very fruitful. Good luck and good trading. This is Cameron Trey from Holo Trading and Projects, a division of Holo Trading Academy. Thank you. Enjoy the rest of your day.